evening, good morning, good afternoon, depending on where you're joining us from today. My name is Sarah Backley and I'm Associate Director at the British Chamber of Commerce in Japan. We're delighted to welcome you today to an exciting event in collaboration with the Royal Institute of Chartered Surveyors entitled RICS Global Commercial Property Monitor, and specifically What's Next for Japan. We'll begin today's session with a short presentation from our keynote speaker, Sean Ellison, Senior Economist at RICS, who will take us through the most recent flagship Global Property Data Survey, which I believe you've all been sent a copy of before the start of this session. Sean will give us an insight into how Japanese property is performing relative to other key markets in the world. Following this, we will be moving to a panel discussion, which I will hand over to the very capable hands of Shigeko Mizutani, Head of Valuation Advisory and Consulting Services for Japan at CBRE. She will bring in experts from Daiwa Kante International and Circlefield Associates to lead a discussion on the impact that COVID-19 has had on global trends and how these are expected to shape the Japanese and global property industry in 2021. We'd like this to be an inclusive discussion, so we please ask you to send any questions you may have for our panelists using the Q&A function at the bottom of your screen. So without further ado, I'd like to now bring in Sean, who will start the session by taking you through his presentation.
Thank you very much, Sarah. And thank you to the BCCJ for hosting us here today. 1 year on, just about from the last time I think we had an event there, which was one of the last in-person events, I believe, that the BCCJ did, and certainly I think it was the second to last in-person event that I did last year. So how time has passed. As Sarah said, I'm a senior economist with the RICS. I'm based in Sydney, Australia. And what I'm going to do here today is I'm going to take you through our most recent global commercial property monitor. You guys are really sort of at the front of the queue here. These results were just released today, so you're probably amongst the first people to actually see them. And what I'm going to do is to try to sort of put Japan in the international context to see how commercial property in that market is performing relative to other markets that we track in this survey. I believe I have some slides, Sarah. Great. Fantastic. Yeah, so for those of you who may not be familiar with the monitor, or who may not have attended this event last year, I'll just give a very, very quick overview of what this actually is. So this is a global sentiment survey which tracks changes in conditions in commercial property markets globally. So it's really important that when you're interpreting this data, you sort of remember that we're talking about changes rather than absolute levels, right? So, you know, it could be dropping from a very high level or rising from a very low level. And it's because we track changes, that's what really allows us to compare markets across borders rather than just looking at levels. So we can put like Japan next to a developing market like Sri Lanka and see how conditions compare. The responses themselves, they can be displayed at the regional, national, and subnational levels. You'll see that all today. The regional data is all weighted. It's weighted using the LaSalle Investment Management's estimates of the commercial real estate universe. In case anyone's curious or wants to know more about how we do that, feel free to reach out, and I'm happy to answer those questions. So in just commercial property in this context, what we look at is income producing property that's not housing. So we do look at multifamily housing, but not detached housing. So we cover that with separate products and only in sort of very few geographies. So for the most part, the metrics that we look at, the headline metrics, are a blend of office, industrial, and commercial, office, industrial, and retail. And then we also sort of separately also look at some alternative sectors now. This was a very recent addition to the survey, and those are things like multifamily, data centers, student housing, aged care, those types of things. So how we measure sentiment is using something called a net balance approach, And there's an example of that on your screen, so I won't take you through that in detail. And just something to keep in mind, because throughout the last several quarters, because there's been such a fast pace of change, that responses are often influenced by the response period. So in the fourth quarter, responses were collected between the 10th of December and the 17th of January. The bulk of responses in Asia Pacific and indeed in Japan were collected in January. So just so you're aware of sort of when those were coming in, and you can keep in context what was happening domestically at that time, which may have influenced some of these responses. All right, so moving on, a quick summary of these results. So what we're picking up is that the impact of the pandemic has been highly uneven. So that's both for sectors of the economy as well as sectors of the commercial property market. And I'll show you what I mean by that shortly. So a good example of the uneven effect on the sectors of the economy are, we run a commercial property survey and a construction survey. And our commercial property survey indicates that commercial property globally remains under pressure, whereas the construction markets appear to be more on the recovery footing already. So you get this real sort of different sectors of the economy on sort of different trajectories. And you get that within commercial property as well, what we're picking up. And there's some fairly consistent themes globally. There is, on a sort of brighter note, it does look like the market sort of hit its low during the second quarter of 2020. And since that, although conditions remain negative, which indicate a continued deterioration, that some of that negative, the downside pressure has eased in Q3 and then again in Q4. And you can really see that when you look at the evolution of our Global Commercial Property Sentiment Index, which is an index that sort of takes in all these different factors on both the occupier and investment sides of the market, things like supply, demand, and forward-looking expectations. So that rose from a low of -37 in the second quarter to -31 in the third quarter and to -27 in the fourth quarter. And there's some interesting dynamics behind that. And again, I'll show you this in an array of charts moving forward. But the improvement from Q2 to Q3 was largely driven by the Chinese occupier market, as well as globally, the investment market appeared to recover slightly more quickly than occupier markets outside of China. Moving from Q3 to Q4, we're seeing more of a broad-based recovery. And it's marginal, but it's more sort of inclusive of more markets. And interestingly, it actually looks like the recovery in China, so to speak, might have hit a speed bump, right? Because we're picking up actually a slight deterioration in that market from Q3 to Q4. Japan's an interesting case. You can see that in Q2, conditions didn't appear to get as negative in Japan as they did globally, but they've sort of stayed at the same level for the past several quarters. And that appears to be a result of a continued uncertainty. And globally, and this is very true in Japan as well, industrial assets continue to be the most favored asset class, so to speak. There's a lot more uncertainties around offices and retail, whereas data centers are still sort of a popular asset class among alternative. And then moving forward, obviously the policy measures and how vaccine rollouts are undertaken will definitely affect, how expectations actually pan out into reality. And there are a couple other risks that we probably should be cognizant about as well at a global level. So if we move to the next slide, we can see how sort of this commercial property sentiment index has evolved in Japan relative to globally. You can see that, as I was saying, the index didn't hit the lows that the global index hit, but it hasn't seen sort of some of that negative pressure ease. So that sort of downside pressure, especially in offices and for retail assets, has really persisted throughout the second half of 2020. And that really hasn't eased to this point yet. Next slide, please. And you can really see sort of some of the dynamics that I was talking about a very broad-based recovery from Q3 to Q4. So Q3 being represented by these little teal dots and Q4 by the purple bars, sort of where this index is in various countries. In most places, it remains negative. With very few exceptions, it remains negative. People in Vietnam and Denmark must really be gunning ahead at the moment. But elsewhere, conditions continue to deteriorate, but not at the pace that they have been in Q3. And if we saw the Q2 numbers on there as well, you would see that the Q2 numbers were, for the most part, slightly lower, although not to the same degree that we've sort of seen the change from Q3 to Q4. Next slide, please. And so one of the interesting things about Japan that you would have noticed is that there really wasn't that change from that same sort of improvement from Q3 to Q4, right? The numbers stayed very, very level. So a natural question is why that is, right? And this doesn't appear to be directly correlated to supply and demand fundamentals, right? Like if we look at how occupier and investment demand has changed from the third to the second quarter, although both of these metrics remain negative, they're much less negative in the fourth quarter, right? And that's indicative of this chart, right? Where you can see that there's been an improvement in occupier demand and investment in inquiries when you're just looking at the change from Q3 to Q4 in isolation. And that's very true for Japan as well. In fact, if you look at the real investable markets that we track, the change in Japan, and especially the occupier market, is one of the larger ones, right? So it looks like conditions have eased to a degree over the last 3 months in Japan's occupier market. Whereas you look sort of at the other end of the table, as I mentioned, China has actually deteriorated somewhat in the occupier market, where from Q2 to Q3, we saw a very large increase in occupier demand, and that's now gone the other way. And similarly, in a market like Italy, which appears under pressure, obviously the prime minister there has just resigned, so there's some other extenuating circumstances in that economy. Next slide, please. And what this seems to be related to is a lot of uncertainty regarding the outlook. So the outlook for Japanese property with respect to rents and capital values does appear to be slightly more downbeat than other markets. And I'll keep in mind that this is a blend of office, industrial, and retail properties, right? So it's sort of an aggregated average of the three. You really have sort of 3 or 4 groups here of markets, where you have the ones that appear to be sort of entering a recovery, your Denmarks, your Vietnams, and to sort of a lesser degree, in New Zealand and some of these markets. And then you have the bulk of global markets where conditions are sort of either in a holding pattern or still decreasing slightly. But for the most part, expectations are much more positive than what they were sort of in the second quarter of last year when you look at the 12-month outlook. And then you have the sort of further down the chains, your places like Hong Kong that remain under acute pressure. And Japan sort of seems to slot in kind of between those two groups, right? A large part of our sample is from Tokyo in particular. So if you were to read this as kind of Tokyo versus Hong Kong versus, say, the big 3 or 4 German markets that we really track, you can really see the sort of relative difference in the outlook amongst those markets, where there's still some degree of rental decline expected and some degree of decline in capital values. Next slide, please. And you also get that when we ask respondents on their perceptions of the phase of the property cycle. So a higher share of respondents in Japan believe the market is in a downturn. And there's no respondents from Japan who felt that the market was either at its bottom, so about to turn a corner onto the recovery footing, or sort of in those early stages of a recovery, right? And you can see that globally, about half of respondents see their markets in a downturn. In Japan, that's closer to 2/3, right? And almost a quarter of respondents globally see their market as being in the early stages of a recovery, which is quite clearly much more optimistic than respondents in Japan sort of felt where their market was at. And again, this, I should stress here that this is, again, at a headline level. It doesn't sort of look at the different asset classes. Next slide, please. This does break down some of the asset classes. So, you can see the real difference and the real expected outperformance in asset classes here, right? And the shock hasn't hit every asset class evenly. I think that's one thing that we have certainly learned from COVID-19. So what appears to have happened is that industrial has really remained this quote unquote most favored asset class, right? Where there's still a lot of pent up demand for industrial assets. And why might this be? Because this is something that's very, very evident globally, right? And is certainly the case in Japan. Well, we need to remember that, there's still this large weight of capital on the sideline, right? Where there's a lot of investors that are flush with cash, especially given what central banks are doing globally, and they need to allocate that cash to something, right? So bond yields are very low. The structural sort of dynamics of the retail market aren't really favorable, and offices, there's still a lot of uncertainty over what sort of the future of the office is, right? And I'm sure we've all seen the various research on that. Whereas industrials, it seems that what COVID-19 has done negatively to retail, it's done positively to industrials, whereas, it's sort of sped up that trend, that deterioration of retail globally, the rise of industrials globally. Next slide, please. And you get that too when you're looking at foreign investment inquiries, right? So foreign demand, the industrial sector had much more of a cushion over the past several quarters. And you can really see that back in 2019. And if I was to extend this, time series further back than that, you could see office and industrials were sort of moving in tandem for a time. But now the office, demand for offices from cross-border investment remains, very weak. Whereas for industrials, although cross-border demand is still quite weak, it's at least stabilized for that asset class. Next slide, please. And this is this is indicative of some of the uncertainty around offices. So in the second quarter, we actually asked what our respondents expected the scale back in the company's office footprints over the next 2 years. So how much will companies reduce their occupied space? And globally, on average, once we weight everything out, it was by just under 8%. So that's that 7.8% number. In Japan, it was actually even higher. It was almost 10%, which is, a fairly significant difference. And if you think if occupiers in Japan suddenly cut their space by 10%, that would have a very significant impact on the market, and is obviously something that's contributing to the current sort of uncertain environment. Next slide, please. And then finally, just to sort of overview how some of the alternative sectors are looking. So this is the annual expected change. I should say these are capital value expectations for both the office, industrial, retail, as well for this slide, looking at alternatives. So again, sort of similar to the more core asset classes, data centers are really expected to outperform. This seem to accelerate that trend to a degree. Whereas, really unsurprisingly, hotels, I guess, are the retail of the alternative sector, where, they remain under a lot of pressure in many, many markets. Whereas the outlook for things like multifamily housing, aged care facilities, those two asset classes tend to be a bit more idiosyncratic depending on the specific market that they're in, right? Because some markets obviously are sort of very upbeat, and other markets, not so much. And then finally, I'd just like to bring something back. I mentioned in the introduction that, sorry, if we could move to the next slide, please. I'm just going to go over this very, very quickly. I mentioned in the introduction that obviously policy measures, the pace of the vaccine rollout will all affect the outlook, how much of this these expectations become a reality, is something that we actually talked about when I was in Tokyo a couple of years ago, that some RICS members might remember, was sort of a warning around the Chinese credit cycle. And in particular, debt risks at Chinese property developers. So the chart on the left, it is a couple of years old, but it gives some context to just sort of the scale of the issue. And what it does is it compares to the top 40 non-Chinese developers against the top 5 private. So these are non-state-owned Chinese developers, right? So, and when you look at market cap and enterprise value, the two are almost equal, right? So, you have 5 Chinese developers that are almost the size of 40 very large global non-Chinese developers, right? So the scale of the property development market in China is just absolutely massive. But the thing to remember here, and the thing that I pointed out back in 2019, which seems like it was a decade ago at this point, was that the assets to equity ratio, right, where the equity was basically about half of the level of assets, which means you have about half of your assets are equity, half of your assets are funded by debt, right? For non-Chinese developers. When you look at Chinese developers, the assets to equity ratio just gets blown out, right? Where a lot of these developers are more leveraged than, say, an investment bank would be, which should obviously raise some red flags, because investment banks are in the business of lending, right? They should have a lot of debt. That's what they do. Developers, not so much. So there was obviously huge risks about sort of an unwinding of this market. And this really started in 2018 into 2019. We saw the amount of defaults rise. Since then, there was a bit of a reversal in policy. So credit started to ease again in China, which alleviated some of these pressures. A lot of that was a result of the trade war as well as the COVID-19 shock. So authorities didn't want to basically deal with a vast string of defaults. But that's then changed again from a policy paper that was released in December, which shows that credit markets in China are going to start tightening again. So this, once again, is sort of a risk that remains on the horizon. And we're already seeing some onshore defaults rise. We're already seeing some more talk about expected defaults at credit ratings agencies internationally. And the one thing that, is really worrying is an unexpected default, which means that if a company that was deemed to be healthy suddenly defaulted on a debt payment, and what that would do would essentially reset the price of credit on the onshore Chinese market, and probably cause sort of a domino effect of a lot of other companies sort of coming under pressure. So with that, I'll end my presentation. Thank you very much.
Okay, then we will go into the panel discussion. Including Sean, we have 3 panelists from different location and field profession. So they will share us the insight on dynamics that will drive Japan's market throughout 2021 and beyond. So may I introduce Sean Ellison and Koji Tanaka and Miho Asano. So these are the 3 panelists who will be sharing their insight. So I would firstly like to ask our panelists, how has COVID-19 environment affected your business and profession? So as you have heard from the Sean's presentation, since the outbreak in March last year, the world has affected in various ways. So not only the real estate, but overall the economy. And there are media, publication, and research about COVID-19 and its effects. But we would like to hear from our panelists their real experience with COVID-19. So Sean, would you like to kick off?
Sure thing. I'll keep it short because I'm sure you're all getting tired of the sound of my voice at this point. But obviously, you know, I sit in Australia, so things here have been a little bit different than a lot other parts of the world. Certainly, much more different than the UK or North America. You know, these intermittent lockdowns have certainly affected us to some degree. As an example, we were actually in the process of returning to the office in November. And then there was a small outbreak in Sydney in December, and that's basically put us back into full-time working from home until, you know, until next month. There's definitely been an impact on productivity. From a business standpoint, obviously the RICS itself has just recently announced a very large restructure, right? And that was in large part to sort of account for some of these structural trends that are probably going to become the new normal. So movement to a much more sort of digital first environment. But it's certainly it certainly changed the way that we work and interact with our colleagues. You know, it's previous to COVID. You know, I might talk to my colleagues in the UK once a week or something, or once every other week. And now it seems like I'm speaking to them 3 times, 4 times a week. I've never known the British to be so keen to have a chat until COVID hit. Maybe it's the lockdowns.
Right. Thank you, Sean. Yeah, I feel the same. The overall the communication had gotten more tight within globally. So yes, I do speak with more regional colleagues much more than pre-COVID. So it's very interesting how the digital is affecting with the COVID-19. So Koji Tanaka-san, I know you sit in London. So could you maybe share your experience, and you're still in a hard lockdown?
Hi, good afternoon, everyone. My name is Koji. I'm from Japan, but I'm based in London for 15 years. And I'm doing business in London, Eurozone, as well as in Japan, a little in Singapore. So perhaps I can give a bit of feedback from UK or EU perspective on how we are and how we look at the Japanese property market. So first of all, I think, as you know, I think in UK we are suffering, but it's picking up. And one thing is that I think the RICS market survey back in last year shows I think 70% of people are reporting reduction of the workload. So that's the first thing. And in fact, I think workload reduced by 20 to 30% last year. So that's generally in the property, and a little bit better in construction market. So that's the general situation here. But as you see from the recent report, RICS, the residential market, for example, is picking up for the last 7 months consecutively. So this reason is, I think, very important to share with the Japanese people here, because I think the British government implemented a few countermeasures to tackle with the coronavirus situation. One is that I think financial market, they introduced a furlough scheme to support the salary of the employees in the closed industry. That's the one thing. And the second thing is that tax, in terms of stamp duty tax and other taxes, they put holiday period to waive some of the tax requirement to sustain the transaction of the residential houses and so forth. So these are the key measures which the government has have introduced during this tough period, and that resulted in a bit of a recovery in the price and also inquiries of the housing market. So I think this is probably one of the case studies to show that the effective countermeasure could work, not only in the UK and perhaps in Japan and worldwide. So we really have to think is not just to see the trend now and in the future, but also we have to think about what we can do, what sort of measures we can take and implement in the market. That's what I see at the moment. And also maybe we can cover in the later topic, there are a number of technological development I think we're doing right now. So as in Japan, this is probably the same in Japan, but we are developing the system of BIM, Building Information Modeling System, which can incorporate cost evaluation and the program into one design element, and we can deliver the building as quickly as possible. So I think this sort of the technological development certainly is beneficial for entire property and also construction market. So there's certainly a few things can be done in the technology sectors, not only like planning and so forth. And the last thing is that perhaps I want to discuss detail a little bit. Well, in UK, the planning system now incorporates a bit of more flexibility between office, retail, and the residential sector. I think slightly different in Japan, a city planning system, city planning law, but in here, office is office, retail is retail, and residential is residential. So the three uses are traditionally separated under the Planning Act and so 1990 and so forth. But now the government introduced a bit of a flexibility, so which means you can convert from retail to office and office to residential and so forth. So depending on the occupancy and depending on the situation for each sector. So we have to see how it develops, but I think certainly in Japan, if there's any shortage or oversupply of certain element of property, then it could be one of the things we could do to change the use from one sector to another. That's what I see at the moment. Thank you.
Thank you, Tanaka-san. Very insightful information. And I think your background is from construction. So I think there are a lot for Japanese construction industry to learn as to what kind of measures are taking currently in the UK. So thank you very much. And so Asano-san, I understand you sit in Singapore right now, and your family and your business platform is in Japan. So how has the COVID-19 affected you and your business? Maybe you can share with us.
Yes, thank you for the introduction, Ms. Benson. Hello, everybody. I'm Miho Asano. I'm the CEO of Dayas Kante International in Singapore. I'm a trader with over 20 years of experience. In July 2017, I set up a Singapore office and been living in Singapore ever since. In October of the following year, I established a Bangkok office. I am supporting Japanese clients in Southeastern Asia. Before COVID-19, I have been traveling back and forth between Tokyo, Singapore, and Bangkok. So the big impact COVID-19 has on me was that I could no longer watch movies on the plane. Let's let's move on the main topic. So I would like to share the file shows the status of Japanese real estate market with COVID-19. Before I present the data, let me give you a brief background. So Daiwa Real Estate Appraisal is my platform company and one of the major appraisal companies in Japan. Therefore, we consider the trend in the number of appraisal companies in Japan. Therefore, we consider the trend in the number of appraisal increase to Daiwa to be a leading indicator of investment. This is the monthly of the number of appraisal increase to Daiwa. After big drop in April, it has recovered significantly since the end of May 2020, when the state of emergency was lifted. In June, it returned to the same level as before COVID-19. Since October, it has been growing even more steadily. The speed of this recovery shows the resilience of Japanese economy. Did the effects of COVID-19 on my sound, Mizutani-san? Thank you.
Thank you, Asano-san. Yes, I think the appraisal market does reflect the trend of what's going on in the capital market, and we do understand that the inquiries are increasing. And I think that's as Sean mentioned before, that there's a capital ready for deployed to Japan as well as other global markets. So with that, I think as Sean touched on, and I kind of feel that the things are changing, global trends are changing. And the COVID-19 has accelerated or maybe deaccelerated the global trend that had been happening previous to pre-COVID. So like the global capital trend and technology and how the office used. I think there was a question regarding the office, how it may be converted in future. So I think it's maybe good to hear maybe from Sean how COVID-19 accelerated or deaccelerated the global trend and what you see going forward in this area.
Yeah, sure. Thank you very much. So, I mean, it's really had an uneven impact, I think, not to beat a dead horse here, but, it's really had an uneven impact between the different sectors, right? Where, as you sort of touched on, it's really accelerated sort of the changes that are undergoing in retail. As well as the sort of logistics market, right? Where there seems to be some degree of certainty behind those two asset classes in particular, right? And one of the things that's actually come out of COVID that's been very interesting is sort of what to do with suburban malls that have very low occupancy ratios. I've seen some stuff out of the US where they're actually turning those into affordable housing, right? So in markets where you have a shortage of one type of an asset, you're basically converting these retail places into a different type of asset. To your point about accelerating global trends, and I won't speak too much about some of the capitalization rates and that sort of thing. I think offices still remain a really big question mark, right? And there was a question in the chat that I see about why the office reduction ratio in Japan was higher than in other regions, right? And I don't have a definitive answer for that. But one of the things that we were really picking up pre-COVID was that the availability of space to occupy was very low. And certainly Tokyo is probably the prime example of that, where there was just no availability to rent anywhere, right? And obviously rents had been pushed up to such a high level that if you're a company, right, you need people to do a job, but you're also paying quite a bit of rent off of your bottom line, right? And that obviously affects your sort of revenue flow. So if, if you found that this sort of, whether it's a strictly working from home or blended working from home is acceptable, like it doesn't take as big of a hit to productivity, then there might be that sort of mentality where we're going to continue with that for some time, right? And especially when there's uncertainty around your revenue, right? Your revenue streams. I mean, one of the most interesting things about COVID, and this will sort of be the last thing that I say about it, was that it's really so unlike any other crisis that we've been through. If you look at, say, 2000, comparing COVID to 2008, the depth of 2008 might actually be lower than what we hit in COVID. The pullback might actually be more. But our data anyway indicates a very quick bounce back for property, right? Because an office in 2007 was still an office in 2011, right? Like they were used in the same way. Whereas the way we utilized office space in 2019 might not be the way we utilize office space in 2022, 2023, right? So that sort of uncertainty behind the new normal has really had a major effect on the recovery for commercial property. Thank you.
Right. Thank you, Sean. Yeah, I totally agree. That it's COVID-19 is a virus, so it's affecting a human being, and that has changed our lifestyle or the way we think or the mindset or the behavior. So, and that is affecting the real estate market, I think. And I think, Tanaka-san, you touched on the how the measures are taking in London. So maybe can you share with us some of the development or residential market on that part, or what, your insight or the global trend change?
Yeah, I'm sorry, I have a bit of a difficulty sharing the screen. So perhaps please allow me to speak, and because I'm speaking on the iPhone right now. And, my thought about the global trend, I think my key thought is whether there's any change in the fundamentals of the overall society right now. And we are aware that there's a bit of a uncertainty in terms of the COVID-19 and the political situation right now, as we have seen in Hong Kong or perhaps in US election and so forth. So, but putting aside this uncertainty at one side, what we really have to see is with the fundamental change in the concept of growth of overall economy, including population, will continue as we have continued since the end of the World War II. So I think we have to make it clear whether we haven't seen at the moment any fundamental changes in this trend. So what we have seen right now is most probably we have to think about a bit of based on sector-wise and also the local wide rather than globally, because that each sector like office, retail, residential started to show a little bit difference in terms of performance and so forth. And also that locally, either in Asia, either in Japan, started to show difference from other markets in the world. So that's something we have to pick it up at the bottom line level rather than, I think, focusing on global trend. That's what I see, because the global trend at the moment has not really seen the fundamental changes at this moment. So we have to be very careful. And the other thing is that I think that, as you always see, the Japanese population decreasing. This is many people highlighted, but in the UK, it has been still increase around 0.7% per year. So it means that there's a bit of a difference when we talk about population or worldwide economic situation, because Japan is one of the rare countries, I would say, where the population decreasing. So we have to be a bit of a careful when we analyze the local market. Is it really the population decreasing or increasing in certain market? Because that fundamentally changes the method and the conclusion of analysis of local markets. That's what I see. So I think there are a few measures I think we should talk about. in Japanese property market, what underlines? Well, my conclusion is the global trend has not changed much, although we have to be cautious about the political changes, uncertainty, and the coronavirus difficulty at the moment. But nevertheless, I think we need to focus on few countermeasures, what can be done in the Japanese market, especially about population and so forth. Thank you.
Thank you, Tanaka-san. Yes, there are many changes, happening in the global trend, and maybe we can go into what may be the implication to Japan's real estate market with the global trend change. So, Asano-san, do you think maybe you can touch on this? What's the implication, for this global change to Japan's market?
Yes, I'd like to comment on the cap rate in Japan. Let me share the file. I would like you to look at the file for this point as well. This graph shows the trend of standard cap rate since October 2013, which are used by Daiwa for valuation. The standard cap rate for office, residential, urban retail, suburban retail, hotel, logistics are reviewed every 3 months to reflect the market conditions. I'm going to focus on the effects of the COVID-19. In April 2020, we raised the hotel's cap rate by 0.1% due to the change in market conditions of hotel industry. As you can see, the cap rate of hotels was getting lower and lower before COVID-19 due to the expectation of the Olympics. On the other hand, we lowered the logistics cap rate because of the intense investment instead of hotels. For offices, we recognize the risk of future vacancies, but have not made any changes so far. In response to the government's actions in January, we have upped the cap rate for urban retail because the tragic COVID-19 impact has increased the risk of cancellations and vacancies in urban commercial buildings, especially those with food and beverage. As for suburban shopping malls, the figure was set to remain unchanged. In this way, there are changes in the cap rate for determining value. However, I do not think the appetite to invest in any asset itself has been affected. This is because, as explained earlier, there has been no significant change in the number of increases to Daiwa. This is our opinion, Mizutani-san.
Thank you, Asano-san. Yes, we've seen a significant, compression in some of the sectors in the Japanese property market. So it's amazing how the overall COVID-19 trend is affecting the real estate market directly. So yes, there are some things that we do need to think about going forward for 2021 with our investors. So Sean, for your last comment, what do you think maybe the kind of the implication to Japan's real estate market from your view?
Look, I'm certainly not the expert on just Japan's real estate market. I might leave that one to the other panelists, but I might use this opportunity to sort of answer a related question in the chat from Ron Gormley, who, I'm glad you attended again this year, Ron. It's good to hear from you. So Ron asked, for anyone who can't see it, whether Tokyo's potential as an Asian financial hub, given the events in Hong Kong, right? Obviously, there's a lot of concern over the future of Hong Kong and a lot of questions about Hong Kong as a future financial hub. And in my view, Tokyo is sort of the best placed to take advantage of this. That doesn't necessarily mean it will happen, because there are a lot of sort of moving parts, and certainly a Seno fan sitting in Singapore might disagree. But what Japan has to its advantage, it has a very deep and a very developed financial market. And before Hong Kong was the Hong Kong that we've sort of known for the last couple of decades, Japan was the financial hub in Asia, right? So with a deep and developed capital market, the step that it's really missing is the labor laws, right? The ability to import and export labor. Because if you look at sort of the ease at which expatriates were able to relocate to Hong Kong and sort of come in and out, having lived there for 6 years myself, it was an extraordinarily easy process to do, right? Whereas the adjustment to Japan, whether it's language, whether it's sort of some of the labor laws that are in place in Japan, that's sort of the one sort of major impediment where Singapore does at this point have a bit of an advantage, and perhaps Taipei, although I don't know about that market, so to speak. What I expect will happen Asian financial centers is probably something similar to what's happened in the wake of Brexit, where you get businesses moving to various locations across Asia Pacific, but one more than other. And I think it would be sort of very, very wise for the relevant authorities in Japan to position itself as a way to receive a lot of that relocation, because it definitely has it's done all the hard work with deepening its capital markets and acquiring all the financial expertise that it needs. It's just the easy steps that are sort of left.
Thank you, Sean. So I think we are a bit short in time, so I may have any last question from the audience, if there's any. Yeah, the topic is quite huge, and I guess we are not really had enough time to go through and share our insights. But basically, I think the things are changing, many things are changing, and there are many medias and publications. But I think it's good to share like this through this webinar to get together, because it's getting a bit the world is getting much smaller with the technology. So I hope we can share this kind of insight together with you going forward. So back to you, Sarah.
Thank you. And I see we have another few questions come in, but perhaps if the panelists are okay with this, I'll share their email addresses afterwards or contact details, so you can ask them directly. So I'm sorry, time has escaped us. I'm sure that's all we have time for today. But once again, a huge thank you to our three panelists, Sean, Asano-san, Tanaka-san, and also our moderator, Mizutani-san, for your time today and you're sharing your valuable expertise. For everyone else also on the call, thank you for coming. I hope you found the session enjoyable, informative. Please stay tuned for future BCCJ events. And if there are any topics that you'd like us to cover in future sessions, please drop us an email at info@bccjapan.com. Thank you very much.